Hello, Matthew Bell here. I have a license to sell health and life insurance products, and today I am going to talk a little bit about the different dividend options that you might have if you have a whole life policy that is from a dividend paying company. So some whole life policies are sold from companies that are participating, and some companies are non-participating. And a participating company basically is one where the policyholders have an ownership interest, and in those cases, then those companies are going to pay a dividend. Other companies are stock companies typically, and the people who have an ownership interest are the stockholders. They're the ones that receive the dividend, and the policyholders do not. Now, without getting into too much regarding that, I'm going to get into some of the structure of those companies in a different video. You should be mindful of the fact that when you have a whole life contract that has various dividend options, you have, generally speaking, the ability to change the way that the dividend is delivered to you. Now, I should say, for tax purposes, the dividend is usually considered to be an overcharge of premium or a return of excess premium. Now, people who are, whether agents of companies that are non-participating or people who are down on whole life insurance, will often say that the payment of a dividend shows that the premium rates are too high already on a policy that is able to qualify or eligible for receiving a dividend. However, in some interest rate environments, it wasn't uncommon in the past for dividends to exceed the actual premium. You should be aware of the fact that there isn't a kind of a direct line that can be drawn between, well, here's what you were paying and here's the dividend, and so the dividend is basically bringing the premium payment down to a reasonable place or back down to where it would be if you weren't being overcharged for it. Overcharge in this case is a tax term, and I think it's best thought of as simply a tax contrivance, really, to allow that dividend to not be susceptible to taxation, because it's considered to be a refund of premium that you've already paid, and you don't receive a tax deduction for privately paid insurance premiums. But without getting too far into that discussion presently, what I am going to stick with is simply the options that a person who has one of these policies, a person should be aware that there are different options for how the dividend is going to be delivered to you. Now, the first option, and usually the default option, is going to be having the dividend reinvested into the policy, essentially. So the dividend, when it's placed back into the policy, is usually said to purchase paid up additional insurance. So if a dividend is being paid into a policy, the dividend is paid back into the policy, it's going to purchase a little bit of additional insurance every time the dividend is assessed. Now, you can think of these as little, almost single premium policies. Single premium policy is a policy that you pay on one time, and you have a certain amount of insurance associated with that. Now, the amounts that are being contemplated here are usually much, much smaller than you would be able to buy insurance for. So you wouldn't be able to contact a life insurance broker or agent and say, give me $30 of insurance, just $30, here's $30, and give me whatever that's going to buy. But when you have a whole life policy that is being paid into it, a dividend, the dividend may function in precisely that way. You may have a dividend of $30 or $200 or whatever the dividend is, and then there may be an amount of insurance that's associated just with that gets added on to the policy. So the cash value increases a little bit, and the death benefit increases in an amount that is commensurate with what that dividend was able to purchase in insurance benefit. So that's option number one. I'm actually going to go over 8 options. They're not necessarily all offered from every insurer, but these are 8 options that you may encounter, and it may be worthwhile talking to your agent or to the company's representative to see which, if any, options might be available to you. There may be circumstances in which you would prefer to have one or other of these options selected, and you should bear in mind also that ownership in the policy allows you to change the dividend option and set it, and it doesn't have to be set once and then forgotten about. You can kind of tinker with it. There may be pluses and minuses to doing that, but you should be aware that it is an incident of ownership. So another common option is to have the dividend paid to you in cash. So for some people, they'll just check cash payment, and what happens is when the dividend is assessed, and dividends are never guaranteed, the dividend check will simply be mailed to you Some people use this in a similar way to how they might invest in a dividend-paying stock company and receive a dividend check every quarter or every year. Now, dividends in a stock situation are different. Those are taxed generally as regular income unless you're investing within some kind of a vehicle like an IRA or a Roth. But in a life insurance context, the dividends are considered to be a return of premium and therefore are not taxed. Now, another option for dividend is that it can be used to reduce the amount of premium that you owe on the policy. Now, in many cases, this is going to be a factor when you have an annual premium pay mode. So how you pay a life policy, you might pay it monthly, you might pay it quarterly, you might pay it semi-annually or annually. When you pay it annually, what will happen is the dividend that is given to, let's say if the dividend is paid annually, the dividend will be applied to the policy premium. And if the policy premium, let's say, is $1,000 a year, $500 a year, whatever it is, and the dividend is $200, then the $200 will reduce the cost of the premium amount. And so instead of being $1,000, it'll be $800. Instead of being $500, it would be $300, or whatever the values are. Now, you should be aware that when you select an option other than to use the dividend to have paid up insurance, in a certain sense, what you're doing is you're preventing the policy from sort of growing the way it might be intended to grow. So you want to be careful. If the policy was set up, let's say, to be a retirement supplement, then you want to be careful about tinkering with the dividend option, because it may be that the dividend option being set a certain way was planned for a specific end result. So if the policy is designed to be a cash growth or a tax shelter vehicle, then you want to be careful tinkering with the dividend option, because the policy was probably set up self-consciously with a particular dividend option selected. Now, sometimes with whole life policies you have cash value, and I get into this in another video where I get into just a sketch of what whole life is. But whole life basically has a living benefit and a death benefit. Death benefit being the payout when the insured dies, and the living benefit being the cash value that accrues as premiums are paid and as dividends are paid into the policy and so on. Now, one of the privileges of ownership in a whole life policy is essentially that you have the ability to take a policy loan against the cash value. Now, if you take a policy loan, it may be a good idea or it may not be, depending on your age, depending on the amount of the loan, depending on the reason for it. But you might make a policy loan to yourself. There'll be an interest charge that's assessed. And so one of the uses for the dividend is to help pay down the loan or reduce the loan amount. So if you have a policy loan, you can be aware that the dividend can be used to help to offset the amount of the policy loan. Another option is that the dividend can be held in almost a separate account, if you want to think of it that way, and just the dividends are allowed to sort of accumulate on deposit. Now, if the dividends are allowed to accumulate on deposit, there can be a tax consequence. The dividend itself is still tax-free, but any interest that is generated on that dividend, if it's in an interest-bearing account, will be susceptible to taxation, whether that is receiving a 1099 interest statement or whether it's held in an account and the taxes are deferred until you take a distribution. Either way, the interest on the dividend may be taxable even if the dividend itself is not. So we've looked at paid up additions, we've looked at taking a cash dividend, we've looked at reducing the premium, reducing the policy loan, and accumulating on deposit. That's 5. Number 6 is an option that isn't seen a lot nowadays, and that is accelerated endowment. So in a lot of cases, an endowment basically on a whole life policy is referring to the time period where, or the point in time where the cash value and the death benefit are equal. So what happens with a whole life policy is that the cash accumulates and sort of the amount of insurance is reduced over time. There's more and more cash, and the cash theoretically builds to the point where it coincides in terms of a numerical amount with the death benefit. Now, for most people, the death benefit, or for many people, many uses of whole life, the death benefit is supposed to be there when the insured dies. If the policy endows prior to death, it can be a nuisance on the positive end, and it can be destructive in some cases to the plan if the person outlives the endowment. So many whole life policies today are designed to endow at age 120. And they're designed that way so that it is highly unlikely that anybody is going to actually live to see the endowment, so that the policy will be in place for death. On the other hand, policies from just a few years ago may endow at age 100, which accomplishes more or less the same thing, but there are a few people who are able to outlive those. And again, that was the reason the endowment was kicked out to age 120. But several decades ago, it wasn't uncommon to see policies that were designed to endow at age 65, age 70, age 60, whatever. And they were intended to be retirement supplements. Now, changes in the tax code and the way that these endowments are taxed makes those unattractive in today's tax environment, because you are basically anything over your cost basis is going to be taxed as regular income, which can add a considerable amount on to your adjusted gross income for tax purposes in a year that you were, let's say, to cash out that endowed policy. So it tends to be that they're not an attractive option for retirement. But when they were, one of the uses for the dividend was to accelerate the endowment. That is to say, it might bring it forward. So if your endowment was supposed to be at age 65, maybe paying the policy using the dividends might allow that policy to endow at 64, 63, whatever. Again, that's not an option that's generally seen or exercised today. Another is similar to it. It would be referred to sometimes in the literature as paid-up insurance. And the idea here is that if you have a certain premium schedule, so let's say the policy is a life paid up at 65 or life paid up at 100 policy. Well, in some cases, the dividend can be assessed not to next year's premium, but to the premiums that are down the line. So let's say a dividend might be applied to pay off a policy more in advance, so that instead of being life paid up at 100, now it's life paid up at 99. Now it's life paid up at 98. Now this is a similar idea to accelerated endowment, but what it's changing is not the endowment date, but it's changing the end date where the policy's final premium is going to be due. So for example, a person who's 30 years old might take out a life paid up at 65, not because the policy is going to endow at 65, but because their final premium payment will be due at age 65, and then they won't carry a premium expense into their retirement. So sometimes the dividend can be used to feed into that aspect, so that instead of being paid up at 65, now it's paid up at 64 or paid up at 63. The expense will go away a little bit earlier. Again, whether this option is available is going to depend on the insurer in question. Whether or not it's worth exercising as opposed to some other option is going to depend on a lot of factors. Your insurance agent or broker is probably able to illustrate the policy's growth using one option or another to kind of give you an idea of whether or not one or other option might be more suitable for you, given the purpose that you had in taking that policy out, and given the way in which selecting different options is going to change the calculus for cash value growth and other things. Another final option is that in some cases the dividend can be used to pay for what's called 1 year of term insurance. And even though this amount is going to be comparatively small, in some cases the dividend can be used to kind of give a little bit of an extra benefit over what it would purchase in a paid-up edition. So in a paid-up edition, the dividend is used to purchase a little bit more whole life insurance. In 1 year of term, the dividend is used to purchase some value of term insurance, and that amount is usually a little bit higher than what the paid-up edition would purchase. Now, there's several relevant differences. The first is that there's a difference between term insurance and whole life. So when a paid-up edition is used to purchase whole life, that is going to be a permanent fixture of the policy unless or until a person cashes the policy out or surrenders that paid-up edition or surrenders the total cash value, versus the 1 year of term, which is, of course, term insurance. Now, there could be a reason for a person to select 1 year of term. One reason might be a person has received an unfavorable diagnosis, for example. The extreme case of that might be a person who receives a diagnosis of some kind of a terminal illness, and in that year they use their dividend to purchase basically as much insurance as they possibly can, since they could never be underwritten for a new policy given their terminal diagnosis, or at least they couldn't be underwritten for a policy that wasn't a guaranteed issue policy. In that case, they might opt to select 1 year of term to give their death benefit a kind of a supercharge and to get it up a little bit higher to benefit the beneficiaries. So we've gone through number one, the dividend purchasing paid up additions. It could be paid up, it could be paid in cash. It could be used to reduce the next year's premium. It could be used to reduce a policy loan. It could be allowed to accumulate on deposit. Could be used to accelerate an endowment, although that's not generally used anymore. Could be used to purchase paid up insurance, which is essentially the idea that you're going to have fewer payments down the line because this is going to the dividend is going to start taking away from future payments. And it could be used to purchase 1 year of term insurance. Now, I want to stress once again, not all of these options are available on every policy, even a whole life policy where there are some dividend options. Not every whole life policy is from a dividend paying company. Whether or not one or other option is good for you in your situation is not something I can answer. This video is not intended to provide financial advice, insurance advice, or anything. It is simply for general informational or entertainment purposes for you to have a conversation with your own agent. You would need to do that in order to ascertain whether or not one or other option is appropriate for you or your family, whether it is appropriate given the purpose that you have in taking the policy out, and it's going to depend. There are various purposes. It could be a burial policy, it could be a tax shelter, it could be a life insurance retirement plan. There's a number of different end aims that you might have in taking a whole life insurance policy out, and some of these dividend options may be counterproductive to certain purposes. However, they're good to know because if you run into a money crunch some year, it's sort of good to know that you might have the option to use the dividend to help pay the loan down or help pay down the premium. But you want to watch that because if you allow it to remain in that option, it might handicap or hamstring the policy and prevent it from doing what you intended to do. I hope something that I said was of use to somebody. If you found something of use in the video, I would appreciate you liking the video. Feel free to subscribe to the channel. I have some other content coming out, and I appreciate your time. Thank you very much.